If somebody handed you $1 million right now, where would you put it? Into the stock market, where your money works while you sleep? Or into real estate, where you can touch the walls, collect the rent, and build something real? This is the debate that keeps investors up at night, and today, we're going to settle it. Not with opinions, with math, with data, and with the truth that most people don't want to hear. Let's start with stocks, because this is the path most people think of first. You take that $1 million and drop it into an S&P 500 index fund. Historically, the S&P 500 has returned an average of about 10% per year over the last 30 years, with dividends reinvested. That means your $1 million, left completely alone, could grow to roughly $6.7 million over 20 years. You don't manage anything. You don't fix toilets. You don't screen tenants. You open an app, check the number, and go back to your life. And the liquidity is unmatched. Need $50,000 for an emergency? Sell some shares. It settles in days. With real estate, you'd need to refinance, take out a loan, or sell the entire property, which can take months. Stocks also let you diversify instantly. That $1 million in an S&P 500 fund spreads across 500 of the biggest companies in America. Tech, healthcare, energy, finance. You're not betting on one neighborhood or one tenant. You're betting on the entire U.S. economy. Now, let's talk about what $1 million looks like in real estate. Because the stock market crowd always leaves out one massive detail: leverage. With $1 million in cash, you don't just buy $1 million worth of property. You can put 20% down on multiple properties and control $5 million worth of real estate. That's 5-to-1 leverage. The bank puts up 80%. You put up 20%. But you get 100% of the appreciation and 100% of the rental income on the full value. So, let's say you buy 5 rental properties worth $400,000 each. That's $200,000 down on each. Right now, the national average gross rental yield in the U.S. sits around 6.5%. On $2 million worth of property alone, that's roughly $130,000 a year in gross rental income. After mortgage payments, taxes, insurance, and maintenance, you might net $40,000 to $60,000 per year in cash flow. Meanwhile, your stock portfolio is growing quietly in the background. But it's not putting cash in your pocket every month, unless you sell shares or collect dividends, which on the S&P 500 average around 1.3% yield. On $1 million, that's $13,000 a year in dividends. Real estate's monthly cash flow crushes that number. Now let's talk about the tax game, because this is where real estate pulls ahead in a way that most people completely overlook. When you own rental property, you can deduct mortgage interest, property taxes, insurance, repairs, and, here's the big one, depreciation. The IRS lets you write off the value of a residential rental property over 27.5 years, even if the property is going up in value. And when you're ready to sell, you don't have to pay capital gains taxes right away. Through a 1031 exchange, you can roll your profits into a new property and defer those taxes indefinitely. In the stock market, every time you sell at a profit, the IRS takes a bite. Up to 20% in long-term capital gains, plus the 3.8% net investment income tax if you're above certain income thresholds. Real estate gives you legal tools to keep more of what you earn. But let's be honest, real estate is not passive. That's the trade-off nobody likes to talk about. You're dealing with tenants, repairs, vacancies, property managers, insurance claims, and local market shifts. Pipes burst at 2 a.m. Tenants stop paying. Cities change zoning laws. This is a business. It requires time, energy, and knowledge. There's also the risk factor. Real estate is highly concentrated. If your rental is in a market that declines, your equity disappears fast. And because you're leveraged, losses hit harder too. A 20% drop in property value when you only put 20% down means you've lost 100% of your cash investment. With stocks, a 20% market drop means you've lost 20%. Leverage magnifies gains, but it also magnifies pain. And here's something else most people forget about: inflation. Both assets respond to it, but in very different ways. When inflation rises, the cost of building materials, labor, and land goes up, which pushes property values higher. Your rental income rises too, because landlords adjust rents to keep up with the market. Meanwhile, your mortgage payment stays locked in at the same fixed rate you signed years ago. So your costs stay flat while your income climbs. That's a built-in inflation hedge that stocks simply don't offer in the same direct way. The stock market can keep pace with inflation over long periods, but in the short term, rising prices often squeeze corporate profit margins and rattle investor confidence, leading to sell-offs. Real estate tends to ride the wave of inflation instead of fighting against it. So, what actually wins? Here's the truth. The answer depends entirely on who you are. If you want simplicity, liquidity, and consistent long-term growth with minimal effort, stocks win. The S&P 500 has been one of the greatest wealth-building machines in history. You don't need special knowledge. You don't need to manage anything. You just need patience. If you want cash flow, tax advantages, and the power of leverage, real estate wins. But it demands your time, your attention, and your willingness to learn a skill set that most people never develop. Now, here's the thing. The wealthiest people in this country don't choose one or the other. They do both. They use real estate for cash flow and tax benefits. They use stocks for growth and liquidity. They let the two work together. If you've got $1 million, putting it all in one basket is the biggest mistake you can make. Split it. Let real estate pay your bills today. Let stocks build your future tomorrow. That's not just smart investing. That's financial architecture. You're building something that works whether you show up or not. And if you don't have $1 million yet, start with whatever you have. Buy your first index fund. Save for your first rental. The point isn't the amount. The point is the structure. Build the machine now, and the money follows. If this helped you see things differently, hit subscribe and turn on notifications. Thanks for watching, and I'll see you in the next one.